Hello, everyone. Welcome back. Welcome back to the chat room. My name is Ed Ponzi. It's great to be here with you today. I'm speaking to you on Friday. It is Friday, September 19th. We came to you a little bit later with our second session this week so that we could also discuss the results of the Scottish referendum in the UK. But so much happened this week. So much went on. So, we're going to get right to it. First, starting with the Fed and Janet Yellen on Wednesday and the impact they had on the market. You can see that you're looking at the stock market here. This is the S&P 500, and you can see that we've been moving straight up pretty much ever since. And here's Fed meeting day. I'm going to take you to the intraday chart here on the S&P 500 for just a moment, so you can see how the markets actually reacted to her words, and the way she handled it. I thought she did a very good job with this. I think there you see it right here. 1400 is 2 p.m. In New York, and you can see that the S&P 500 shot down for 5 minutes. This is on a 5-minute chart, and then proceeded to rally and has continued to rally ever since. And how do we make sense of this? It's because there is always something happening underneath the surface, okay? And the first point I'd like to make is that everyone was focused on two words. Everybody was focused on the Fed statement and the words considerable time, meaning that, will they leave the words considerable time in the statement? In most people's minds, the words considerable time mean that rates will stay at zero for 6 more months at least. So the words considerable time did stay in there, but watch the brilliant balancing act that Yellen does. So rates are going to stay low, but at the same time, she projected interest rates to be higher by the end of next year. Previously, she had given a projection of approximately 1 1/8%. Now she raised it to 1 3/8% by the end of 2015. So she was giving with one hand and taking away with the other. She also gave a higher projected GDP for next year and higher projected inflation. So, and this is going to, by the way, this is going to tie in very nicely to one of the questions that I was sent this week. So, if growth is high, if growth is stronger, inflation should be stronger, and rates need to go higher, but they're not going higher right away. Do you see how she's balancing it out? And the market really liked this balancing act because she seemed to be saying good things about the economy, but she also seemed to be saying that the punch bowl is not going to be yanked away all that quickly, although it is going to be pulled away, and we all know that it's going to be pulled away. Okay, so fascinating stuff, right, as far as what is going on. And a fascinating reaction in the market, I would have to say. So stocks up sharply. The euro, right, check out the euro's reaction at about the same time. I'll take you back to the 17th. At 2 p.m., which is going to be 1400 hours on this chart. And you can see Euro USD just plunges. We go from around 129.60 to around 128.60 in a couple of hours. About 2 hours later, Euro had lost 100 pips. And so, that just goes to show you that they like the dollar on this news, and they saw it as a good reason to sell euros. Now, the first thing you want to ask yourself, was the reaction as dramatic on other currencies? In other words, are they just looking to dump euros, or do they really like the dollar? Well, they sold off the pound as well on that news, though not quite as sharply. Okay, and we'll take a look at Aussie. Okay, they sold off the Aussie, or did they? Just a second. They sold off the Aussie pretty sharply as well. So it was really all about the dollar. They like the dollar on this news. If you go to the DXY, the daily, you see the dollar has been just still chugging higher now since the beginning of July. Dollar's just been on a rampage here. Has it slowed down a bit? Yes, it has. You've been in a sideways range for most of September on the dollar, but I think the impressive thing is that there's really no retracement. After this massive run-up in the dollar, it hasn't pulled back at all. It's just, you know, hanging up here near its highs. And I think that says a lot. I think it says a lot more about Europe than it does about the U.S. I don't think the U.S., you know, obviously if U.S. growth was that strong and impressive, rates would be going up now. They're not. So we're still at emergency rates. We're still at 0%. Officially, the Fed rate right now is in a range between 0 and 0.25%. That's the official Fed range. And right in Europe, the official rate is 0.005, which is just, I guess, a way of saying zero. No, it's 0.05. Pretty darn close to zero. Switzerland, the official rate is 0. We'll be talking more about Switzerland in just a minute. And, you know, the UK, 0.5, which doesn't sound very high, but it's actually higher than Japan, Switzerland, the US. Japan is 0.1. All right, so all these zero interest rates, the only ones that are really at 1 or above are, you know, you have New Zealand at 3.5 and Australia at 2.5. If you look back, you know, over the past 10, 15 years, New Zealand and Australia have always had a higher rate than the more developed, bigger economies of the U.S., Europe, Japan, and Great Britain. And that's just been a constant, so it should not come as a surprise. It doesn't really tell you anything new about those countries. It doesn't tell you that they're doing better because they're not at 0. They're always higher than the U.S., than Europe, than Japan. Okay, and all right, and speaking of Japan, by the way, I got to tell you, like USD/JPY is just on a phenomenal run here. Gets above 109 today. This is one of those deals where for the longest time it would have been very easy to fall asleep. For most of the year, dollar yen was just in a couple of hundred pips range for most of this year. But low volatility leads to high volatility, and the volatility has come back with a vengeance. Let's pull up the ATR for a really good look at the volatility. This is great news for traders. Look, we were very fortunate that we made 350 pips on a euro trade this summer, and essentially it's like swimming in a swimming pool that only has 1 foot of water in it. You know, like when you're down here on the ATR on dollar yen, it's only moving 30 pips a day. 30 pips a day for dollar yen in late July. Now 73. Volatility is back with a vengeance. We always said it would come back. We never know. You never know when. Look at this one. Here's the euro. Euro is moving about 40 pips a day at the beginning of August, now at 85. So the euro and the yen have more than doubled in volatility. Great Britain. The UK, the British pound was moving at about 55 pips per day. Now it's moving at 125 pips per day. All right, that has more than doubled in a short period of time, and suddenly we're back into volatility. You know, funny thing, you know who's going to benefit from this? The Forex brokers are going to benefit from this. We might even pick one up. For example, FXCM, right? This stock really came down hard when the volatility was down. When the volatility was hitting its lows in the currency market, FXCM was hitting new lows. Now that the volatility has taken off, look at the way the stock has come roaring back. It's not a coincidence, okay? When volatility is high, the brokers make more money, and traders come back and trade more. Traders press, more orders get filled. And the more orders get filled, the more buttons get pressed, the better it is for the brokers. So the volatility has come roaring back. That's FXCM. We also have GCAP, which trades in the U.S. GCAP has not shown those great gains. This is more of a small cap stock, but I would point out that GCAP appears like it may have bottomed. This could be considered a cup and a handle here, or this could be also considered left head right, like an inverted head and shoulders. But just be very careful with GCAP. That's Gain Capital Holdings. The main reason why I would be careful with this is that it is a small cap stock. Normally, all my stock traders out there know we don't touch stocks that have a market cap of less than $1 billion, and anything under that would be highly speculative. Well, Gain Capital falls into that category. It's highly speculative. It has a market cap of, I think, about $500 million. So very, very light on the market cap there, and that means it's dangerous to own. Okay, let's get into some questions here. We're going to go back to the currency world here. We'll cover stocks again in a little bit. By the way, look at that engulfing candle. I don't know if it's technically engulfing, but I'll tell you this: the bulls. Boy, the bulls had a severe disappointment yesterday in the euro. I see this pattern as going lower because, look, this is what we call the bear flag. Okay, this is a bear flag. We're going to put a parallel there. There you go. There you go. So you have the flagpole, the flag, and so if this came from about 131.50 to 129, then it should drop us from 129 to about 127.50. And we've said all along 127.60 is the support level here, 127.60. So that actually fits very nicely with this pattern. So 127.50, 127.60, that's your support level. There's also the 61.8 fib comes into play here. That's 127.65. And that's like if you rally from the low to the high, just pin that on there a little bit more closely. You know, you have a 61.8 fib coming into play soon. It's a little bit higher than I thought, but a little closer to 128. But still, we're getting pretty close to the 61.8. So there's a lot of support down here is what I'm saying. Between 127.50 and 127.90, there's like 3 different reasons why you could see a bounce. But first you have to get down to that point. So euro falls at least another 100 pips before that happens. Nobody likes the euro right now. Now, I want to tell you too, you know that I'm long euro Swiss. I'm sure you've heard me talk about this. This came down pretty hard the other day. What happened is that the Swiss National Bank, first of all, the Swiss National Bank reiterated what they've been saying for a long time. What have they been saying for a long time? That they will buy unlimited amounts of euros. They will purchase unlimited amounts of euros. And they also said they are ready to do so immediately. And they threw in there that, listen, if that doesn't get it done, there are other measures that we can take as well. Now, when we say other measures, you think about the other measures that have been taken recently by the European Central Bank. What other measures have they undertaken recently? Well, we know the European Central Bank is going to do quantitative easing. I don't think Switzerland is quite ready for that yet. But the European Central Bank did something else recently. They have what we call a negative deposit rate now in Europe. And think about it this way. You live in Europe. The deposit rate is negative at the bank. Unless you go to Switzerland, where the deposit rate is not negative. Where are you going to put your money? You're going to put your money in Switzerland. A money flow into Switzerland makes the Swiss franc stronger. So I believe the interpretation that we're seeing here is that the Swiss National Bank is threatening to go to a negative deposit rate, to keep that money from flowing in. You know, as we like to say, when it comes to currency trading, you follow the money. And when I say follow the money, it means if money is flowing out of Europe and into Swiss banks, that's going to make the Swiss franc stronger. You can see the Swiss franc did get stronger despite all of these comments, which is fine by me, because we're still well above the 120 level. There you see it. There's the weekly chart. And we're getting, so we are able to get some at 121.50. We got more at 121. We got more at 120.50. When this shot up last week, we let some go. We let about half of it go. And now that it's coming back down toward 3, we're going to re-add. We're going to add that back in. We're going to buy more, and we're just going to keep doing that. You know, this is the plan. You know, we are going to load the boat. Hopefully it comes all the way down to around 120 and 120 plus 10 pips. And if it gets down there, then we get our largest piece of the puzzle. Our largest piece of the position sits there. We have orders waiting to buy. So I'm not at all discouraged by the movement. Heck, it came down. We got some. It went up. We got rid of some. It's coming back down. Looks like we'll get some more. I can play this game all day. Okay, I don't mind a bit. Okay, and now let's talk also a little bit about Great Britain, because now we have the referendum is complete, GBP USD. The referendum is now complete, but I think it's very interesting the way this happened. If there had been a yes vote, the belief was that the British pound would have crashed. Instead, we got a no vote. But do you see how the pound was creeping up before the vote? It was priced in. By yesterday, the no vote was fully priced in. And if you were curious as to why that might be, consider this. In places like the UK and elsewhere, it's very easy to walk into, say, a William Hill or some other betting parlor and place a bet on the British referendum. Well, the money that was bet on this referendum overwhelmingly was leaning toward the no. In other words, it's as if they knew, as if someone knew ahead of time and had placed a large amount of money on that. So you can see the initial reaction is that we popped way up to 165. There's your knee-jerk reaction, but the truth is it's already priced in. It's already priced in, and we come floating back down beneath 164, and now almost down to 163. Why? Look at the trend, okay? The trend is down. So here's what I'm trying to say. When some people heard that the vote was no, they hit the buy button on pound dollar and pushed it up to here. Why didn't it hold up there? The problem was no vote was already priced in as cable had been climbing for days. And the polls reflected that, right? The poll that showed that the yeses would win, the I vote would win, was right here. And that was it. That was the only time that showed. And ever since then, the noes took the lead back and their lead began to grow. So it was fully priced in. So if you hit the buy button here, that was a huge mistake. It's obvious now to say it's a huge mistake, but why are you going long when it's already up 300 pips from the lows? You see what I'm saying? It's already come up 300 pips from the lows. You're not supposed to be buying. All right? And what is the trend, folks? What is the trend? The trend is down. So if it does pop up, then your bias should be towards selling, because the trend, right? Don't we always try to go with the trend here? Very rare that we're not going with the trend. I will grant you that on Euro Swiss we are not going with the trend, but that is a very different scenario from this. Okay, this is now a trend trade that's been jolted around and become very volatile thanks to the news. But at the end of the day, it's still a trend trade. And at the end of the day, this is a downtrend, and it's still a short. Okay? The hourly chart, for those who are thinking in terms of multiple time frames, the hourly move was kind of interesting. You see that big jump? I'm going to throw the RSI up there, the relative strength index. This gave several sell signals which were premature, but the last one nails it. This one is saying RSI comes up, that means get ready to sell, and just as it comes down, where does it come down? Right here. It's telling you to sell on that candle. Do we not wish we had sold on that candle, on that hourly candle? Yes, I think so. Although fair enough to say that not all of these trades would have worked. This one has us selling too soon, so you're probably going to get stopped out. This one looks like it's going to work as well. This one works as well, right? This one has you selling right here, so right after the peak. So RSI works well here. It works very well here. It's going to result in a small loss here and a small loss here. Why do I say a small loss? Because we don't take big losses. We only take small losses. We're not afraid to lose. We'll sit here and take small losses all day if we have to. We are not afraid to lose. We do not want to lose big. That is the main difference. Okay, all right. Hope that answers some of your questions about what's been going on in the world of currencies. It's endlessly fascinating as always, and we do have questions about currencies, and I'm going to get to that next. Okay, here we go. Question time. What are the most important steps for a country to do when they're in inflation and when they're in deflation? Okay, well, the inflation, it's hard to find any examples of countries that are in inflation. Right now, most countries are either stable or deflating. And so we can't really give you an example of anybody who's in inflation, but when a country is in inflation, they will tend to raise interest rates. That is the best course of action, because if you think of interest rates as you're driving a car, and when you're lowering interest rates, you're hitting the gas. When you're raising interest rates, you're hitting the brake. So you're driving this car, right, and you don't want it to go too fast because you'll get a speeding ticket, and you don't want it to go too slow because then you'll be a hazard, and cars will be running into the back of you. So you want to keep it going at the right speed. Is that fair? So when we're in inflation, that means the car is going too fast. The economy is growing a little bit too fast. We have to tap on the brakes to slow it down because we don't want to get a speeding ticket. And deflation means the car is going too slow. That means it's time to step on the gas. This is the situation that most of us are in. Now, we said earlier, most of these countries have 0% interest rates right now. The U.S., Europe, Japan are all virtually zero. Switzerland, virtually zero. All of them. So they've already got their foot to the floor. They've got 0% interest rates. They can't lower rates any further, but the car is still not going fast enough. So what do? Now they take extra measures like quantitative easing, right? Quantitative easing is designed to drive interest rates even lower. And why? Because you want low interest rates, because if I can borrow money, if I can get a 3.5% mortgage, I'm much more likely to buy a house than if I have to pay, say, 10% interest. I'm much more likely to buy a car if I can get 2% interest instead of 5% interest, you see? So they want us to buy houses and cars and stimulate the economy and open businesses and buy things because the interest rates are very low. That's the goal of all of this. And so the problem is, right, you've got your foot all the way to the floor and you're trying these extraordinary measures. that's where we are, because we already have our foot to the floor, and we are looking at potential deflation in Europe right now. Why is 2% inflation good inflation? Okay, because that's the speed of the car at its proper speed. You're going with the flow of traffic. You're not in any danger of deflation. You're not in any danger of getting hit by a car behind you, and you're not speeding. You're not in the danger of inflation. So you keep a low rate of inflation is considered ideal. And that's why the goal for almost every country has a goal of inflation of around 2%. Right now, Europe is coming up very short of that, at less than 1%. And this is why they are now taking extraordinary measures. Japan has been in deflation for years. That's why they have had a 0% interest rate for years, and that's why they've been doing quantitative easing for years. Great question, by the way. Also, there's another question. When the Swiss National Bank decides to buy the euro and sell the Swiss franc, and what they're doing is, that's exactly what they're doing, by the way. They're using their Swiss francs to buy euros. They're exchanging Swiss francs for euros. Will it affect other euro pairs like euro-US dollar, euro-New Zealand, euro-Swiss? Yeah, I mean, if the Swiss buy a lot of, let's say that euro-Swiss comes down to 120. If the Swiss then engage in a big round of buying near 120, could that create movement in euro, US dollar, etc.? It absolutely could. It would be not nearly as noticeable, but you might see the euro jump up a little bit in sympathy with what's happening in euro-Swiss. Because the fact is, a lot of buying of euros will push the euro up against currencies other than the Swiss franc. There are also other algorithms and computer programs that see the euro going up against one currency, and they automatically buy it against another currency, and that helps it to go up too. So the answer is yes, but it's not nearly as dramatic. You know, if you do see a lot of buying by the Swiss National Bank, you could see Euro-USD move up a little and Euro-New Zealand move up a little, but it won't be nearly as dramatic. It's a great question. Here's another question. Here's one about gold. What do you think of this? I think gold's terrible. I mean, we had gold and we dumped it. You see this? You see this pattern? We said, well, look, we bought gold. It had this flag pattern here, and it bumped up, and we got above this line, we bought it, and when it got below this line, we sold it. Pretty simple. You know, we bought it because it was breaking out to the upside. The breakout failed, and this was the support level, this line right here. So when that support level broke, we got out, and no regrets, right, because it just kept going down. And could it go to 1080 is the question, or 1180 rather. Well, if I pull up, here's what I see. This is the big support level, boom, right there. And that's about 1185 to 1180. So, yeah, could it go to 1180? I think 1180 looks like the next stop, quite frankly, for gold. I don't see any reason why it wouldn't. Now, a lot of people talk about seasonality. They feel that it should be getting stronger due to seasonality, but that's just not happening right now. Okay. Now let's move on. Just a few notes on stocks. Apple, they are lined up for 20 blocks on Fifth Avenue in Manhattan right now to buy the new Apple phones. It's probably a good sign. But, you know, we're not that impressed yet. They have very high expectations for the new Apple phone. So it's not moving. But you know what? We're up 27% since we bought it. So thank you, thank you, thank you, Apple. JCPenney having a rough day today, coming down hard. And you know, the truth is, I'm not sure what happened. This actually dumped while I was speaking to you, so I'll look into it. But we bought this at $8.60, so even with today's pullback, we are still way up, but that is very disappointing. And if it gets under this line, I'm going to consider taking a profit on JCPenney. Let's talk about some more stocks that we are holding, like Dean Foods. Dean Foods is not doing us any favors once again. Boo, Dean Foods. Okay, and on the short side, right, we have the Lulu. Man, this thing is still hanging in there, but it hasn't gone up since that initial pop. And frankly, we're pretty close to where we bought. We were up very nicely on this down here. So now we're just down a little bit. We're not down a lot, but we're down a little bit. Hate to see us down, but we're not down by much. LVS, we are down a little bit. No, I'm sorry, we are up a little bit on LVS. This has pulled up in recent days, but it has hit lower lows. WIN is the one that's given us trouble too on the short side, but that is now, we're losing on this one just a little bit, but not by much. And Kimberly-Clark, we're basically break even. I think we're up a little bit on Kimberly-Clark now. This, when you consider that the S&P 500 just hit a new all-time high, this is not a very impressive chart at all. Okay, so that's our little review of currencies and stocks. We'll do it again next week. So I just want to say thank you very much to everyone for joining in and listening. I'm very happy to hear from you. So please do send questions in to info@edponzi.com, and we will try to answer all of your questions. Until next time, everybody have a fantastic weekend, and we'll speak to you very, very soon. Take care.